Here is the overview of today's gold market news. Precious metals price performance, price trends, and technical outlook. Impact of U.S. inflation reports and economic uncertainty on gold prices. Gold market price discrepancies and large movements from London to New York. Geopolitical tensions and trade wars drive gold demand amid rising inflation concerns. Let's have a look at the latest precious metals price performance, price trends, and technical outlook. Gold prices are on the rise due to various factors, including geopolitical tensions, trade war fears, and economic uncertainty. These trends intensified following the inauguration of U.S. President Trump in the 20th of December 2024. Gold has reached an all-time high, trading at $2,935.80 to $2,954.94 per ounce, continuing a strong upward trend. This marks the longest weekly rally for gold since 2000, with the yellow metal on its 8th consecutive week of gains. Gold continues its attempts to settle above the resistance at $2,930 to $2,940 as traders stay bullish despite the pullback in commodity markets. If gold settles above the $2,940 level, it will move towards the psychologically important $3,000 level. Analysts anticipate that gold will face psychological resistance when it hits $3,000 per ounce. He expects gold to hover around this level before potentially breaking higher, depending on U.S. fiscal policy and the Federal Reserve's actions. Gold is currently finding support at its 5-day moving average, and until momentum changes, the outlook remains bullish. Analysts highlight that despite gold being potentially overpriced, the bullish momentum remains strong as gold is seen as a flexible asset, driven by strong fundamentals. Analysts are watching closely to see if gold will reach $3,000 an ounce in the near future. Among the factors driving gold price surge are geopolitical tensions. Fears related to trade wars, particularly following the tariff policies of former U.S. President Donald Trump, have increased demand for gold. Weaker dollar index and inflation fears has added to gold's appeal as a safe haven asset. Rate cuts by major central banks and increased ETF inflows have provided additional support for gold prices, as well as banks moving away from holding traditional currencies in their reserves. A key factor contributing to the rising gold prices is the outflow transfer of gold from the Bank of England's vaults to central banks, especially those in the U.S. This is due to rising gold demand in the U.S. driven by Trump-era tariffs on gold exports from Europe. Analysts have identified potential risks to gold's upward trend, which include a faster-than-expected cooling of inflation, a more aggressive tightening of fiscal policies by central banks, a potential rebound in the U.S. dollar, or rising bond yields, all of which could exert downward pressure on gold prices. Silver is also on a positive streak, seeing its 5th consecutive week of gains. Despite some daily fluctuations, silver remains up by 1% for the week, trading at $32.51 per ounce. Silver pulled back as gold-to-silver ratio climbed towards the 90 level. Relative strength index is in the moderate territory, and there is plenty of room to gain momentum in the near term. If silver declines below the $32.50 level, it will head towards the support level at $31.45, $31.75. Platinum tests support at $980 to $985 amid broad pullback in commodity markets. In case this test is successful, platinum will move towards the 50 moving average at $964. Moving on, let's have a look at the impact of U.S. inflation reports and economic uncertainty on gold prices. The upcoming U.S. personal consumption expenditures inflation report could provide an impact on gold prices. If it signals lower inflation, there may be expectations for the Federal Reserve to cut rates, which would likely support gold prices. Chicago Federal Reserve President Austan Goolsbee stated that he does not expect the inflation reading from the Personal Consumption Expenditures Price Index, which the Federal Reserve uses for its 2% target, to be as alarming as the previously reported Consumer Price Index data. He pointed out that the January Consumer Price Index data report showed a 0.5% month-over-month increase, and the year-on-year Consumer Price Index rose to 3%, the highest since June. Economists generally expect the personal consumption expenditure index to show a less significant increase than the consumer price index. They acknowledge that, while inflation is still a concern, significant progress has been made in reducing it from the highs of 2022. The inflation outlook had been looking better until uncertainties arising from U.S. policies, geopolitics, and tariff issues emerged. Next, let's look at the gold market price discrepancies and large movements from London to New York. The price discrepancy between New York and London has triggered one of the largest movements of physical gold in recent years. Major banks like JP Morgan Chase and HSBC are capitalizing on the gap, using commercial flights to transport gold from London to New York. JP Morgan alone plans to deliver $4 billion worth of gold this month. To meet rising demand, financial institutions have been using costly commercial flights to transfer physical gold from London to New York, contributing to the increase in New York COMEX vault stocks. Some gold bars are first sent to Swiss refineries to be recast into the specific size required for COMEX contracts. Others bypass this process by exchanging gold in London for bars that meet U.S. specifications or sourcing gold from Australia. The surge in gold withdrawals from London has caused significant delays and strain on the London gold market, with the Bank of England struggling to manage the high volume of requests. Traders seeking to retrieve their gold have faced lengthy waiting times. This disruption is reminiscent of the 2020 gold market disruption caused by the COVID-19 pandemic, which grounded flights and shut down refineries. The large movement of gold from London vaults to the US has triggered defaults and concerns about settlement of gold trades as well. The London market, which handles cashy spot gold contracts, has faced significant disruptions. The estimated 400 million ounces of London gold contracts for immediate settlement have shown widespread defaults, with an estimated 10 million ounces of gold drawn from London vaults. Delays in gold deliveries from London have been attributed to the slow pace of the Bank of England's gold lease facility. However, this is seen as an excuse, as leasing gold is a typical practice when market participants do not have the metal they are required to deliver. The Bank of England has long been a trusted custodian for global gold reserves since the year 1697. A significant depletion of its gold reserves could raise concerns about the security of its vaults and its ability to meet rising demand, potentially affecting investor confidence. However, London remains a major financial hub, and the Bank of England is expected to adapt to these challenges. Two major Swiss refineries, Metallurg and Arger have begun to impose surcharges on their gold production. Arger has even stopped producing certain gold products. This reflects the strain on the gold market as London contract holders begin to take action to secure physical gold. Moving on, let's have a look at the latest geopolitical tensions and trade wars driving gold demand amid rising inflation concerns. Geopolitical turmoil, particularly in Europe, is increasing demand for gold. Investment in gold-backed exchange-traded funds has been rising due to these uncertainties. The upcoming German elections and potential outcomes may further drive risk aversion, boosting safe haven demand for gold. The trade tensions between the United States and Europe, driven by U.S. President Donald Trump's tariff threats, have led to a sharp rise in gold prices in the U.S. This has created a significant price gap between gold in New York and London. Gold futures in New York soared 11% in the year, reaching to $1,909 per troy ounce, while London gold prices lagged behind by approximately $20 per ounce. Goolsbee expressed concern about the potential impact and scale of President Donald Trump's new tariff policies on inflation. Trump has been considering imposing large-scale tariffs on goods from trading partners such as China, Mexico, and Canada following the recent 25% import tariffs on aluminum and steel. He noted that while Trump's administration did impose tariffs in his first term, they did not significantly affect inflation, primarily because they were more targeted and included exemptions that prevented disruptions in supply chains. In addition to the inflation, he was concerned about the broader impact on supply chains as well. He cautioned that broader and higher tariffs could have a significant supply shock, similar to the disruptions caused by the COVID-19 pandemic, which could further worsen inflation.